Hello everyone, this is Helen Shruti from B Optum second year, Shastra University, Tirumalai Samudram, Tanjavur. In this video, I am going to explain about final accounting. How to prepare final accounts? First, final accounts are the end results of the whole accounting process. Final accounts has two statements. First, income statement and position statement. Income statement includes trading and profit and loss account, and position statement includes balance sheet. Trading and profit and loss account shows the results of operations, that is profits earned or loss incurred during that year. This is also referred as mercantile system of accounting or recognition of accrual principle. Due to this, we make adjustments for outstanding expenses, outstanding incomes, prepared expenses, advanced income, closing stocks, etc. Balance sheet shows the assets and liabilities of the organization as on a particular date. It is not an account. It is not for any period or year. It shows the financial position of the entity as of a particular date. First, let's see about trading account. Trading account is used to buy or sell equity shares in a stock market. Trading account shows the profit and loss made on a gross basis, that is including only the direct cost of the goods. In trading account, we credit the trading income like sale and debit the cost of goods sold. Alternatively, opening stock and purchases is debited and closing stock is credited to trading account. Other direct expenses related to purchases and manufacture of goods like carriage inward, wages, etc. are also debited here. Purchase return and sales return will be deducted or adjusted from the purchases and sales respectively. The balance is known as the gross profit or gross loss, which is transferred to profit and loss account. Now let's move on to profit and loss account. It shows the performance of the entity. Profit earned or loss suffered considering all indirect expenses and incomes. Gross profit or gross loss from trading account is transferred to profit and loss account. Other income like discount, interest, etc. are credited. Administrative expense, selling and distribution expense, financial expense, income tax, losses, etc. are debited to it. The net profit or net loss is transferred to profit and loss appropriation account or otherwise to capital account. If trading account is not prepared, then in place of gross profit or gross loss, all items of trading account will come in profit and loss account itself. In profit and loss account, debit side will have indirect expenses and credit side will have all indirect incomes. Next is balance sheet. Balance sheet shows the financial position of the entity as at a particular point of time. It shows what and how much entity owns and how much it owes to others. The balance is the owner's equity. It is not an account, hence does not have debit or credit side. On one side, assets like fixed assets, current assets, and investments, if any, are shown. On the other side, in addition to owner's capital and reserves, the outside liabilities like loans taken, creditors, expenses payable, etc. are shown. The total of the two sides must be the same. Now let's see about manufacturing account. Manufacturing account, if prepared, shows the cost of goods manufactured during that year. This cost is transferred to trading account. Raw material consumed, carriage inward, wages, power, depreciation of factory buildings, machinery, etc. and other manufacturing expense are debited to it. Opening work in progress stock is debited and closing work in progress stock is credited. Balance is the cost of goods manufactured and is then transferred to trading account. When manufacturing account is not prepared, these items will come in trading account. Sometimes depreciation account may be directly taken into profit and loss account instead of trading account. Manufacturing account is also period statement. The next is trial balance. Trial balance is the statement containing the balances of all accounts as at the end of certain period, usually classified into debit and credit. The total of debit and credit side must tally because Whole accounting is done by double entry principle, otherwise it indicates arithmetical inaccuracies. It has balance of expenses, incomes, assets and liabilities. With the help of trial balance and adjustments, the final accounts are prepared. All expenses and incomes will go into manufacturing, trading, profit and loss appropriation account. Depending upon its nature, and all assets and liabilities will go into balance sheet. And at last, closing entries. After all adjustments are duly accounted, the individual expenses accounts are closed by debiting into trading or profit and loss account. Similarly, all incomes account are closed by crediting to it trading and profit and loss account. Such entries are known as closing entries. Balance of trading account, that is gross profit, is transferred to profit and loss account, and balance of profit and loss account, that is net profit, is transferred to capital account. Thus, we are left with only the balance of assets and liabilities, which are shown in the balance sheet and carried forward to next year's books of account by writing the balance on the other side of the account, and thus account is shown as closed total on both debit and credit side gets equalized. When the books of accounts have been audited and final accounts have been prepared, then the closing entries as above all passed. All assets and liabilities accounts are balanced, shown in the balance sheet and carried forward to next year's account book. It is an accepted norm not to make any changes once the account books are audited and closed. That's all about final account. Thank you everyone.